So I want to understand from you which market right now is really picking up on the scent of a global slowdown and how well placed that scent is.
So I think the fixed income markets have been ahead of others so far, with one important qualification, which is that you're picking up both what's happening in the US and what's happening in Europe. Today is a perfect example. If you wake up and look simply at US rates, with the 10-year at 3.01, with 2s, 10s below 20 basis points, you would think, wow, that's flashing almost recession. However, look at the differential with Germany. That's still at an elevated 270 basis points. So the fixed income market, I think, is picking up the weakness, particularly in Europe, and then arbitrage is translating it around the whole complex. So keep looking at the fixed income markets, but take a holistic view in doing so.
So, Mohamed, the oil market's also screaming something. There's got to be a red flashing light somewhere. There are a lot of people, though, that just say this is the supply shock, similar to 15, 16, it'll clear. Do you think it's anything more than that?
It is. It's the perfect storm. It's three things coming together. One is ample supply. Two is weakening global demand. And three is uncertainty as to whether Saudi Arabia is willing to lead OPEC in playing the swing producer role, in cutting output in combination with other OPEC members and Russia. So you have three different things coming together, and that's why oil has had the terrible time that it's had recently.
So we've seen this movie before. It happened a couple of years ago, Mohamed. Supply shock, high yield gets smacked around. There's a lot of people that think that high yield has had its stress test. You talk to me about the energy beta in that specific part of fixed income and whether you would want to buy the spread widening that we've seen over the last couple of months.
So first, I think it's a reminder that if you go into high yield, don't do it passively. Don't do it through an index product. A lot of people are shocked to find out how much energy exposure they have in high yield. They thought they were buying a diversified basket. So if you're going to go to the lower or more vulnerable asset classes, do it in an active fashion, not a passive fashion. That applies to emerging markets. That applies to emerging market corporates. Second, in high yield, the big surprise so far, Jonathan, is that you haven't had a shakeout of crossover investors. And there's a technical judgment to be made in high yield as to whether that shakeout will come. In the past, it has always come. But the price move has been so sudden that I don't think the crossovers have had time to get back on side yet. So I'd be careful.